What's up, guys? We have an emergency Finance Friday, Saturday. Finance Saturday just doesn't have the same ring to it. I appreciate everyone that responded to that last story and showing some interest in my thoughts and opinions on SVB and what's going on. And so this is very informal. I have some notes up here that I'm going to try to track as we go through this. And my motivation here is not to try to sway your opinion or pass judgment or convince you politically one way or another. I would just try to provide some context for you guys so that as you're reading things and hearing things, you can form your own opinions and at least have maybe more of the landscape sort of understood, and you can ultimately kind of form your own opinions, because this is not something that just happened in the last couple of weeks. There's a lot of history here and a lot of things that happened in particular over the last 3 years post-COVID that led to this. And you kind of got to go back all the way to COVID to really understand what's going on with this bank and what led to its failure. And I'll also say I'm not an expert in this, and there's a lot of news that's coming out constantly. This is 3:30 on Saturday, so by tomorrow, some of the stuff I'm saying might be totally moot. Nevertheless, we'll give it a shot. So for those that don't know, Silicon Valley Bank, just like the name implies, it originated in Silicon Valley and it cut its teeth and made its name in the venture community. It basically just was a tag-along bank to all of these prominent VCs like Sequoia and others. If they saw Sequoia doing a deal, they were going to show up and offer that portfolio company, a line of credit and treasury services, and they were willing to bank them. It was sort of a running joke that their diligence process at SVB was, let me see your cap table. And that was the extent of their diligence. If they recognized names on your cap table, that's really all they needed to see. Conversely, if you had a really strong, healthy, interesting business, but you didn't have some prominent VC on your cap table, they weren't interested. Anyway, that's just their reputation. And I'm generalizing, obviously, but this is a 40-year-old bank. This bank has been around for quite some time, and you got to understand there's like the four big banks, JP Morgan, Bank of America, Wells Fargo, and Citi are the big four. And then you have all of these regional banks around the country that are much, much smaller. Okay, Silicon Valley Bank isn't really considered a regional bank because it's too big for that, but it's not considered one of the big four. It's a top 20 bank and it sits just below that top tier, okay? But this is the second biggest bank failure ever, next to Washington Mutual in 2008, okay? So this reminds me a lot of 2008, although the underlying conditions in the market are different. The nervousness around this SVB issue reminds me of the summer of 2008 when I was trying to graduate with a finance degree and get a job in investment banking, and the market was falling apart. So I have some emotional scars from the last financial crisis, but I did follow that one closely, and so I'm obviously very, very interested in this one for a variety of reasons, not just that. So that's SVB's reputation. Big bank, heavily concentrated in tech, typically, although they have diversified out of tech, and that's an important part of this story. It's not just tech anymore. They're very heavy in finance, very heavy in healthcare, biotech, and it's not just a Silicon Valley bank anymore. They are nationwide because venture capital hubs have popped up all over the country, and SVB's everywhere, okay? So it's no longer an SVB tech-only bank, although that is their primary focus. Okay, and I would say, I think they even made this claim, about 50% of venture-backed companies today are still banked by SVB. So they are heavily exposed to the tech industry. Okay, so what happened post-COVID that's so important to this story? The markets ripped, go figure, in late 2020 and all the way through 2021. Zero interest rate environment, the Fed printing money. I mean, the public markets ripped, and the tech sector in particular was one of the biggest beneficiary of that market run-up. And when the public markets run up, the private markets follow. So that funneled down to the private markets because you have investors in the private space looking to public valuations, which is ultimately your exit. If you invest in a privately held tech company, you're hoping that at some point your company can go public and you hit your big exit, right? And so if you're looking at your exit opportunity in the public market, you're willing to pay more in the seed and Series A rounds because the ultimate exit is bigger. So all of this froth funneled down to the private markets too, where Silicon Valley Bank is the biggest participant, okay? And so all of a sudden, in 2020, 2021, all of their clients are flush with cash and deposits are just increasing exponentially at Silicon Valley Bank. From 2019 to 2022, the deposits at SVB more than tripled, okay? Now, what do banks typically do, and what did SVB do with all of that cash? Because banks don't just sit on that cash. They're going to turn around, they're going to try to invest it, and they're going to try to earn interest on your money. All banks do this, okay? And this was probably the biggest critical error that, if you're going to blame SVB, this is probably the biggest error in hindsight that they made. And look, SVB has blame here, there's no question. The Fed has blame here, there's no question. And there were a bunch of market dynamics that led to this, okay? It's not just one specific issue. But the biggest issue that SVB made is they took this swelling of deposits and they invested it primarily in what's called long duration, low income bonds, primarily mortgage-backed securities. You're going to hear mortgage-backed securities. This is a different issue than '08. I don't want to derail too much, but they were invested in very high grade, low interest, long duration mortgage-backed securities with the majority of their assets. They were not diversified here. This is one of the biggest mistakes they made, okay? And these mortgage-backed securities that they were invested in treasuries as well. It wasn't like, the biggest misconception here for the public is going to be they must have taken all this deposit money like Sam Bankman-Fried and invested it in a bunch of bullshit. They actually didn't, okay? They were relatively responsible with their deposits. They are a bank after all, and they invested in high-grade mortgage-backed security portfolios and U.S. Treasuries. They did not take this money and invest it in a bunch of risky bullshit, okay? So if you hear that, that is not true. But what they did invest in were bond portfolios that have long duration, meaning they bought an asset where they ultimately were going to be paid back on average at least 6 years in the future. So their mortgage-backed security portfolio, the average duration was over 6 years, and it was yielding about 1.6%, or what the finance nerds would call 160 basis points. Okay, so that's a safe asset, really low interest rate, because in 2020, 21, we were in basically a zero interest rate environment. You couldn't go get better rates than that. But they stuck it in long duration assets. So it's stuck there forever. And they compounded the issue by doing this. When you invest in these bond portfolios as a bank, you have to designate it into one of two buckets, either held to maturity, HTM, or available for sale, AFS. They were really heavy in held to maturity, because when you designate these assets as held to maturity, you do not have to mark to market. You're going to hear this term, mark to market, which is a fancy way of saying, hey, on your balance sheet, the value that you're telling me your asset is, what is it really worth? When you're forced to market, it's like, cut the bullshit. What is that bond really worth? But Silicon Valley Bank, they were savvy enough to put it in held to maturity, HTM, which says, hey, we're not planning to sell this asset, so therefore we don't have to market. And so we'll come back to this in a minute, because as interest rates ran up, this became a very, very big piece of the puzzle. But so here's the takeaway, right? They're heavily invested, heavily concentrated in relatively safe, long duration, so far in advance payout bond portfolios that were yielding very, very low interest rates, okay? That's not that big of an issue. But here's where it becomes an issue. In the first quarter of 2022, Jerome Powell, the head of the Fed, was the last freaking person on earth to realize we had an inflation problem. And he and the Fed come out and they say, we're about to raise interest rates and we're going to raise them fast. And they proceeded to do that in a very, very, what some would consider violent manner. They raised interest rates. They raised them at an unprecedented rate. And everyone was sort of afraid of the unintended consequences of that rapid interest rate increase. Nobody really knew what the unintended consequences might be, but we were all just kind of waiting. And I think this might be one of them. But they needed to slow down the economy. Inflation had gone wild for all the same reasons that the tech industry was running up. Inflation was out of control. So the Fed, the Federal Reserve's way of controlling that is to raise interest rates, because it slows growth and it removes incentive for people to borrow money and invest. Okay, so they were trying to slow down the economy, but they waited so long to start. They had a very, very big problem. So they had to really hammer the throttle. So why is this important for SVB's portfolio? So let's go back to their portfolio, which is stuck in held to maturity assets that aren't due for on average 6 years, yielding 1.6%. Well, all of a sudden, the Fed raises rates really fast. Now you can go get a treasury. The rates went from 0 to almost 5%. You can go get a 2-year treasury risk-free for 5% right now, okay? So if you're in a bond portfolio that's stuck at 1.6%, and you have to sell that, the value of that, there's a general rule of thumb with bonds that as interest rates go up, bond prices fall. I can't get into all the technicalities, it take too long, but just understand, interest rates up, bond prices fall. Okay, so if you're Silicon Valley Bank and you're stuck in a bunch of 6-year, 1.6% long duration bonds, who the hell are you going to sell that to when they can go get 2-year risk-free rate for 5%? Nobody wants a 6-year 1% bond, okay? So the value of those bonds were coming down rapidly as the Fed is raising interest rates rapidly. But Silicon Valley Bank is in a held to maturity designation, so they don't have to mark to market. They never had to readjust their balance sheet and tell the market what their assets were really worth, okay? They didn't do anything illegal here. They were playing within the rules, but there was a rule that says you don't have to mark to market held to maturity assets, okay? So they were hiding all of these long duration, low interest rate. They were hiding them, but they just weren't marking the market on their balance sheet. And so no one really realized how big the problem was. And there's a lot of people that speculate that in September of last year, had they marked to market their massive held to maturity bond portfolio, they would have been technically insolvent at that point. Insolvent means your liabilities are greater than your assets, okay? It's a technical term in the bankruptcy and restructuring world, but it portends a lot of things that have to take place if you really are insolvent, i.e. you need to go raise capital. They've probably known about this problem for a long time, SVB, and they waited way too long to address it. This is the other critical mistake that they did make in hindsight. And so what else was going on? So that now, what else happened when interest rates were rising? The tech industry in particular that was so frothy in 21 started getting hammered in 2022. Okay, it was the biggest victim, if you want to use that word. It's probably the wrong word, but biggest victim of the rise in interest rates. Again, another rule of thumb in finance that I can't get into the technicalities of because it would take too long, but generally speaking, technology companies where so much of the return on your investment is further down the road and contingent on an exit, as interest rates rise, the value of that future exit comes down in present value. So the value of tech stocks tend to really get hammered in a rising interest rate environment. So at the same time their bond portfolio is going to shit at SVB, all of their borrowers were under stress as well, right? All of these tech companies were having struggles themselves, and so they start drawing down on their deposits. They're using more and more of their cash that's at Silicon Valley Bank to fund their operation because so many of them aren't profitable. They're having trouble raising money, so they're borrowing more money from Silicon Valley Bank. They're pulling deposits out just to fund operation, and it's happening at a rapid clip, okay? Then to make matters worse, because you can get 5% return on your money, interest, risk-free on treasuries, this is one of these unintended consequences of, I think, the interest rate rise that we now see in hindsight. I'm not acting like I knew all of this beforehand, okay? I'm benefit of hindsight here. But a lot of people looked at treasury like, shoot, I can't get that kind of yield at the bank, so I'm going to pull my money out of the bank and I'm just going to put it in treasuries and I'm going to go get 5% risk-free for the next 2 years. That sounds pretty good right now. So people were pulling money out of the bank for other reasons too, to go get a better return with treasuries. So you had this like draft happening of funds coming out of these banks, particularly SVB. Now these bonds that they had, these long duration bonds, were starting to pay out, and so they had a slow funnel of cash as these bonds paid out coming into the bank, but the withdrawals started to outpace the maturity on these bonds. They had a problem, okay? So now fast forward to this week. This is where it gets really interesting. I had to give you all that context because now this week gets really interesting. SVB, now the majority of their bonds were held to maturity, but they had a smaller, relatively small, but smaller available for sale bond portfolio in AFS. And so because of all these deposits coming out, they sold their AFS portfolio that was already marked to market on their balance sheet, so they'd already marked it down, but when they sold it, they ended up getting $1.8 billion less than what they had marked to market for. So they had a hole in their balance sheet that they had to go plug. So this is not a lot of money for a bank like Silicon Valley Bank to go raise money. So I imagine, and now I'm going to speculate a little bit, but this is where it gets interesting, but I imagine they get on the phone with like 3 or 4 prominent VCs in the Valley, and they probably in a very smug way, again, I'm speculating, but they get on the phone like, hey guys, we need to raise $2.2 billion. We need a backstop for this, kind of mark to market issue on our AFS portfolio that we had to sell. No big deal. Who wants in? And to say that call went bad is the understatement of the last 2 decades. Not only did the investors on that call say, Greg Becker is the CEO at Silicon Valley Bank. Not only do they say, hey, Greg, what's your backup plan if we don't fund this? And how do you know you only need 2.2 billion and you don't need more? Like, what's the real value of your HTM portfolio, and when can you really turn that into cash? They started asking these questions, and they didn't have any confidence in Greg's answers. So not only did they say on that call, we're not investing, they hung up the phone. They immediately pulled their money out of Silicon Valley Bank because they were afraid of the health of the bank. And it's probably 2 or 3 prominent VCs that set off this entire tidal wave. But they pull their money out and they call their portfolio companies that they're invested in, and they say, hey, get your money out of SVB. We're worried about the solvency of the bank. And so all these portfolio companies start pulling their money out. And because it's so concentrated in the Valley, and this is such a small world, the tech community, it spread like wildfire. This call was on Wednesday, and between Wednesday and Thursday, $42 billion was withdrawn from the bank. The VCs that decided not to fund and decided to pull their money out of this was the equivalent of yelling fire in a theater, okay? So some people will take the side that this was a unnecessary self-fulfilling prophecy that just took place and could have been avoided if 2 or 3 of these prominent VCs that had an early look at this investment, this backstop investment opportunity, even if they didn't want to fund it, at least allowed SVB to go have some other conversations instead of just setting off the fire alarm. Okay, so then there's a run on the bank. And by Friday, that call's on Wednesday, by Friday, the FDIC comes in, shuts down the bank and takes it over. And if you're one of the unfortunate companies that wasn't able to get your money out by Friday because you didn't have your ear to the ground and weren't hearing all these rumors throughout the week, your money is stuck there. Okay, so there are companies, if you had $10 million at SVB on Friday, you can't access it today. Well, it's the weekend, but you get the point. So now what? You're going to hear a lot about FDIC insurance, and I'm sure you've heard this term before, but in theory, if you have money at a bank, an FDIC insured bank, up to $250,000 of that is insured by the Fed. So if you had $1 million in the bank and that bank goes under, the Fed will come in and give you $250,000, which sounds great in theory until it happens to you and you're like, well, what the hell do I do about my $750,000 that's remaining? Okay, and you're going to hear a lot this week about uninsured deposits, and that is any money that you have in the bank in excess of $250,000 is going to be considered or called uninsured deposits. So a lot of businesses that have more than $250,000 in a bank realize all of a sudden that we have a shit ton of uninsured deposits, and we're starting to appreciate that term in a far more meaningful way than we did 48 hours ago. And this is the part of the story that could have a contagion effect and could become a bigger issue, okay? And at Silicon Valley Bank, about 95% of their deposits were uninsured deposits. In other words, the average checking account at SVB was $4.2 million. What the hell good does $250,000 do if you have $4.2 million trapped at that bank and that's your only cash? This is an aside, but typically in the finance space, the commercial finance space, if you go get a loan, a line of credit, a term loan from a bank, they will require you to keep your deposits at the bank as sort of a quid pro quo because they want your treasury business in addition to giving you that loan. I think this issue is going to get re-regulated. I mean, in hindsight, that seems really, really unfair on a company. Although I understand it from the bank's perspective, it doesn't allow companies. You're going to be like, you're going to want to second guess all of these companies. Like, why the hell would you keep all your money in one bank? Right? That's a really easy criticism in hindsight. But if you have any debt with a bank, especially a regional bank, they require you to keep your cash deposits there. You are not allowed, as a condition of the loan, to keep your cash in another bank, okay? So don't second guess these small businesses for not hedging their risk, okay? So now it shines a very bright light on uninsured deposits. So this is where it could become a bigger risk. Now you have all these small businesses that have a line of credit with a regional bank. They're forced to keep their deposits there. They're going to panic. They could panic. They shouldn't, but they could. This is the worry. And they're going to go to one of the big four banks. They're going to want to pull all their money out of that regional bank, and they're going to want to go to one of the big four because it's the only banks they can trust, or they're going to want to put their money in a treasury. But where they don't want their money is with the regional bank where FDIC insurance is only $250,000. So you could see a tidal wave of people pulling money out of regional banks, and that is the systemic risk here that needs to be avoided, and the Fed needs to do something before the market opens at 8:30 a.m. Central Time on Monday, or this could become a bigger problem, okay? And so that is the real issue here. is that they need to instill confidence in the small businesses and big businesses for that matter, that this is an isolated event, and that it's not a broader event, and this idea of uninsured deposits is not a scary thing, okay? And if they don't do that, then we've got a big problem. So what needs to happen is between now and hopefully Monday morning, the Fed needs to broker a deal between one of the big 4 banks to come in and buy Silicon Valley Bank and make whole all of these deposit holders one for one and say your deposits are good. We're going to make good on those. Or the Fed needs to come in and backstop all those deposits. But it's a very, very politically sensitive issue to basically say the hell with FDIC insurance of $250,000. We're just going to backstop the whole thing, because that's a slippery slope. Now you've raised the FDIC insurance threshold from $250K to unlimited. Okay, think about that. That's not a great leap. So this is a very, very complicated matter. But I'm just going to tell you, like, if this is not figured out before Monday when the market opens, not trying to be an alarmist, but I'll just say it's not going to be pretty on Wall Street on Monday, okay? And if you start hearing rumors of people pulling money out of credit unions and regional banks, that can have a very unfortunate and violent follow-on effect. So obviously I'm interested in this. I'm going to continue to post updates. If I see anything over the weekend, I'll post them on my stories. DM me with questions. I'll try to get to them. But again, not trying to sway any opinions here. But I think that context is really important. And if I didn't mention it, I probably did, but this is a very easy thing to say. It's exactly like 2008. It's not. It is different, especially when you start hearing mortgage-backed securities and MBSs. You're going to think that it's similar to 2008. It is different. And I hope in some ways you kind of saw the context and why it might be different. But in any event, hit me up with questions. Hope that was helpful in some way. And stay tuned. It's pretty fascinating.